Hello there and welcome to the look ahead for the week beginning let's have a look, the 3rd of February. So that's with me, Fiona Sincotter, Senior Market Analyst here at City Index. So just as we start, I'm going to ask for you to have a quick read of the risk warning and then I will be back with you shortly. Okay, excellent. So just let's start by taking a look at some charts. Obviously, this week has been a really key week as far as announcements have been concerned, volatility is concerned. I mean, obviously, we had the tech rout at the beginning of the week that was sparked by the DeepSeek Chinese new AI model, which was cheaper and or it's expected to, or said it performs on par with ChatGPT, although since then there have been questions and doubts over whether that is actually the case. But even so, it served to remind us that the AI trade, which has had a boom in recent years, over the past year, could be slightly disrupted if we do see changes towards more efficient and cheaper models. What I'm looking at here is USD CAD, because as we head into the new week and over into this weekend, in fact, there are concerns over what will be happening as far as trade tariffs are concerned. We had an announcement from Trump overnight on Thursday saying that he is still planning on pressing ahead with rate cuts, with trade tariffs on Canada and on Mexico. 25 basis points is what he's looking at there. Sorry, 25%. And then in Canada, in China as well, we'll be looking at trade tariffs of potentially 10% on China, although that one didn't seem quite so firm. So what we're going to be looking at as we head into the new week, there is a potential for volatility if those trade tariffs come into force on the 1st of February, as Trump warned they might. Now, it's interesting as far as what's the reaction to this that we're seeing in the market. And this is the Loonie USD CAD. So obviously this stands to be in the firing line if the 25% trade tariff on imports from Canada into the US goes ahead. Now, we did see a spike higher in USD CAD, but it hasn't really maintained those higher levels of fact at all that it reached. However, it has sort of poked its head above this resistance level around the 144.65, 144.68, sort of, sorry, 85 level that we've been sort of watching closely. This is this sort of consolidation pattern that we've been looking at. So basically, if we do get those trade tariffs, will we be looking at a further weakening in the loonie? I think the idea here being that the trade tariffs could be disinflationary for Canada, a country which has already cut, or seen the Bank of Canada has cut its interest rates quite significantly. It's led the pack as far as rate cuts are concerned, and could potentially need to cut interest rates further should that take place. And obviously the alternative is the US dollar here, which if there are trade tariffs being placed on multiple countries that that the US imports products from, then that could have the inflationary effect on the US economy, which would result potentially in the Federal Reserve just not cutting interest rates much at all in 2025 if inflation remains sticky. So that's the Canadian dollar levels that we're looking for. I think it'll be really interesting to see whether we end the week or not above that 44.65, 44.70 level. If we do, then obviously on the upside, then the next one to be watching out for is the 46 round number. That's sort of the high there. And if not, we're looking beyond that further. This is a level that was last seen in March 2020, sort of in COVID era, and that was around the 146.70 level. So they're the levels on the upside. If we get back below this level, below the 144.70 level, then we're back into this sort of neutral holding pattern that we've been trading in since mid-November, although it's worth keeping in mind that we're still trading on above that rising trend line that goes back to September. Just worth having a quick look at the Mexican peso to see what is going on there as well. This is the USD Mexican peso. Again, quite interesting. There hasn't been a massive reaction on, you know, the news that these tariffs are going to be potentially applied this weekend. We can see here that the price has been gently supported higher by an upward sloping SMA. Obviously, on the lower side, we've also got the 100 SMA, which is also holding ground there. So I mean, on the upside, be looking for a rise above here, which was the high that we saw just earlier this month, around the 20.9382. That's the level to be watching on the upside to create a higher high. But as I said, sort of, you know, we're seeing a slight flattening off of this 50 SMA now. So I wonder whether most of that had been priced in already. So, but do just prepare yourself for some volatility on Monday. The other thing to be watching out for, obviously, is gold. Gold is trading at a fresh all-time high. And this is sort of a mixture of those sort of concerns, geopolitical concerns, driving safe haven flows. Interestingly, we're seeing the safe haven flows much more in gold than we have in the Japanese yen. For example, the yen is actually trading lower today, whilst gold has reached all-time highs. But the other thing to keep in mind here is interesting about gold is it's reached these record highs despite a more hawkish stance from the Federal Reserve this week. So that's interesting. The Fed, you know, suggested that it is in no rush to hike interest rates, whilst the data sort of doesn't show, whilst the data continues to show inflation above the 2% target, still elevated, and the labour market resilient. So despite the slightly hawkish stance from the Fed, gold's reached an all-time high. I think there is potential for gold here to continue rising whilst we've got the RSI out of overbought territory. On the upside, 28.50 is going to be the next logical level to be watching. Immediate support, 27.90. That was 2,790. That's the high, the all-time high that we saw back in October. So that is sort of what we'll be talking about over the weekend. Just watch out, as I mentioned, for those trade tariffs, the potential volatility in the market as we come into the new week. So then I think, sorry, the other one probably to be watching out as well, and we've got a couple of data points around here as well, is the Australian dollar. So we've also got, as I mentioned, a couple of data points. We've got retail sales and unemployment, as well as China casing manufacturing and services PMI data, and potential trade tariffs over the weekend. So there are a couple of events that could be moving the Aussie dollar as we head into next week. Obviously, this is considered a proxy for China. So should we get those trade tariffs applied, then we might find that the Aussie dollar comes under pressure. But again, you know, as I've said, the forex market hasn't been showing too much of a reaction to the comments from Trump overnight. So it remains to be seen what will happen there. again, we've got retail sales. Retail sales, if we do see some signs of weaker sales amid a slowing in the amid the Australian consumer. I mean, let's not forget that the RBA hasn't cut rates yet, so interest rates are still relatively high, although the RBA didn't hike rates as high as other countries. But if we do start, see weaker retail sales and unemployment rising, then potentially that's going to fuel expectations of a RBA rate cut in the coming month in February, which could put some pressure on the Aussie dollar, US dollar. As we can see, rallied into resistance here just above. It was the 50 SMA, and it's rebounded lower as we've seen that renewed US dollar strength as well. Levels to be watching out for, this one here, 61.85. Okay, that's the low that we saw in December. It's also the upper band of the falling channel that the price has been trading within, and then that will open the door here to 61.40, which is the 2025 low. So that's levels to be watching on the downside. I think momentum is a little bit on the side of the downside. Also, just look at today's candle. You've got that long upper wick, which suggests there was little buying demand at those upper levels. On the upside, 62.50, that's a level to be watching on the upside, but the 50 SMA is likely to be a test there at 63.10 ahead of 63.40. That was the high that we saw. Sorry, above the high that we saw in this week, sorry, January 24th, last week. So there's sort of the ones that we'll be watching there. I think the other one to watch as well, as far as China is concerned with manufacturing, will be oil. I've got a feeling there's OPEC as well, actually, next week. The OPEC oil meeting with Russia as well. So the OPEC plus that we'll be looking at. I do believe it's actually on the 3rd. Just going to double check that one now, see if I can get a date up for us. But anyway, as far as trade tariffs are concerned, I think it's, so it is the 3rd of February. We've also got the OPEC meeting. Also, let's not forget that Canada and Mexico provide a large amount of crude oil to the US. So that's going to keep oil very much in dynamic as far as trade tariff discussions are concerned. China, the world's largest importer of oil. If we see trade tariffs applied to China at a time when the economy is just struggling a little bit to get back on its feet, means that we could see the oil demand outlook come under pressure. As I said, we've also got the cakes in manufacturing PMI data, so if we see weakness there as well, and let's not forget the official figures did slip into contraction again. So any weakness in the cakes in could also drag on oil prices. Now look at this for a fall from grace. So oil was up at $80 the barrel in mid-January, and we've seen this really significant fall off over the past couple of weeks. It's back below the 200 SMA, and we're back at that 72.50 level. Let's not forget this 72.50, 71.50 support resistance zone at the time, now a support zone, has been pretty key levels as far as the market's concerned. So if we get a break below there, then we're back into this 71 to 67, 66.50 level that we've been trading in for the final quarter of last year. If this level holds, I think what could be helping this level hold would be if we see OPEC perhaps pull back from the idea of increasing output from around April this year, which is what they were planning on doing. They'd been looking to increase output or reduce those voluntary output cuts since around November last year, but actually they haven't been managed to push ahead with it just because of the impact that the weakness that we've seen in the oil price. So that's another one to be watching. Okay, so what we come to next is Eurozone inflation. So let's just pull up the Euro US dollar. Okay, so Eurozone inflation, that is expected, well, just bear with me. It comes after inflation figures today. It's expected, Eurozone inflation increased actually in December, so it just ticked higher to 2.4%, and core inflation remained at 2.7%, but this is still both above the ECB's target level. But as we heard from the ECB this week, as they cut interest rates again for a fifth meeting, the problem in the Eurozone is not inflation, it's growth. So we've heard from policymakers that inflation is still expected to fall towards target sooner than expected. They expect it to be at around 2% by mid-2025. However, if we did see hotter than expected inflation, that could raise concerns over stagflation. Let's not forget that yesterday we saw that growth was stalling. It was stagnant in the final quarter of last year. And the ECB, you know, they're cutting rates in order to support the economy, despite the fact that inflation ticked that little bit higher. But as I said, they're comfortable that inflation is cooling. Worth noting today as well that German inflation is expected to come in cooler than forecast. The actual German inflation reading hasn't been released, but the regional ones have, and they've all been weaker than expected. So, I mean, cooler than expected CPI could support the view that the ECB will continue cutting rates. And obviously that's having an impact on the value of the US euro against the US dollar. We did have this sort of recovery from the low that was the January 13 low below 102. We reached up to above 105, but then actually the price has failed to hold those higher levels. We've seen it fall back down. It's falling out of that short-term rising trend, rising channel. It's also fallen below the 50 SMA. Levels we're watching for down now on the downside is 103.35. That's this support here, which is also the November low. If we do get a break below there, supported by momentum, then that could open the door towards that 102 level. Again, this depends a little bit on what we see happening on the US dollar. If we do see sort of, you know, harsh trade tariff supply, will we see a sort of a continued rebound in the US dollar? Obviously, we had the slightly more hawkish Fed this week, but we did see weaker than expected GDP data. We've still got core PCE, the Fed's preferred rate for inflation, to be released today. That still hasn't been released. And we've got some jobs non-farm payroll data next week, but I'll come to that shortly. So what happens here, you know, if we do get that cooler than expected Eurozone inflation, and supposing we get a solid US jobs report, then that could really help put pressure on this pair towards the 135 level. On the upside, watching here for 104.50. If we get hotter than expected inflation, maybe we get some weakness in the US jobs market. That's what could see the price move up to there. Obviously, there are trade concerns as well as far as Europe is concerned, although Trump hasn't really talked about that last night. He focused much more on China, on Canada, Mexico, and the BRICS, rather than the European Union. So there potentially could be some room for negotiation as far as those are concerned. What's interesting when we talk about what's going on in Europe is if we then have a look at what's going on in the DAX, because whilst we've got the euro looking weak, we've got the DAX trading firmly at record highs. So, you know, this is a rally that we've seen in the DAX. It's risen above its rising channel. It's broken out there. It's looking towards that 22,000 level. We're very much in overbought territory. So, you know, previously when we've seen overbought territory, we have seen sort of a period of consolidation, which we're potentially expecting to see that soon. But obviously the RSI doesn't tell you when these things will happen. But on the upside, yeah, looking for 22,000, obviously 21,500, a little bit of support, a minor support. Really, I mean, there's not too much going on since down to 20,500. So it would take a fall below there to negate this near-term uptrend. You're not going to get a lower low until you move down to the 19,700 zone. So very bullish there, boosted by, optimism surrounding interest rate cuts by the ECB, optimism surrounding sort of a potential recovery in China, and international demand for example, its industry and automobiles. But that's what we're seeing in the DAX. So again, some very strong moves. Let's click on to we also have retail sales. Just worth warning that German retail sales today were significantly worse than expected. So that may bode poorly for retail sales in the euro area. So sticking with Europe, let's just have a look here. Oh, what happened there? Well, not quite sure what's happened to my chart. Very odd. Okay, well, anyway, what's happened here? This is there we go. There we go. We got you back. This is pound US dollar. So we've got the Bank of England interest rate decision next week. Bank of England is widely expected to cut rates by 25 basis points to 4.5%. The Bank of England has cut interest rates twice last year, so in August and November. And just before Christmas, the Bank of England voted 6-3 to leave rates on hold. The Bank of England interest rate is still relatively high compared to its peers. And yeah, so that's expected to be cut by a further 25 basis points. Now, the reason that we've seen the Bank of England move a little bit more slowly is because inflation in the UK has been stickier, but actually there are signs that CPI is cooling. It is to 2.5% in December, and the service sector inflation, which is an inflation gauge which the Bank of England watches closely, dropped by more than expected to 4.4%, which is really good news as far as the bank is concerned. It had been hovering around this 5% level. It was expected to even rise above 5%. But however, it's worth noting that sort of wage growth is still a little bit stronger than perhaps what the Bank of England is comfortable with. And obviously higher wage growth intrinsically sort of lends itself to sticky service sector inflation. However, there are actually signs that the government's budget in October is actually sort of hurting hiring and causing firms to cut jobs. Basically, we've seen that the Chancellor in the budget raised the national insurance contribution and the minimum wage, putting more of a tax burden on employers, which means that they're less inclined to be hiring people and actually looking to cut their payroll. So that means that actually there's increased expectations that we're going to see a weakening in the labour market over the coming months as these moves feed through into the data, which could actually mean that the Bank of England will need to cut interest rates more aggressively this year. So investment banks have already increased their expectations for Bank of England rate cuts to several cuts across this year. The market has been less certain, but I wonder if we're going to see that increase, those rate cut expectations increase when we hear from the Bank of England this week. Bank of England is pointing to several rate cuts this year. Given that the rate cut is 92% priced in for February, we could still see a little bit of a weakening in sterling. But if we see here a more dovish Bank of England, then that could see some weakening in sterling, especially if we do get a sense of a resilient US labour market. As we can see, the recovery a similar picture to what we saw from in the euro. We saw that recovery on from the 13th of January, the low. We've seen that recovery, but it's just run into resistance again at the 50 SMA at this 125 level. This is a trend line here that dates back to 2007. So that, if we just try and have a look at that, what that means to this picture. This is on a weekly basis. I mean, you know, here we're still only going back to what, 2018, but this is a trend line that goes all the way back. As we can see, it goes all the way back, and here we are. We're just actually looking to test that as a support in the coming days around that, below that 125 level. So that's going to be sort of a key area around there, the 123.70. That is the falling trend line, the upper band of the falling channel. It's also this trend line dating back to 2007. Below there, this level here, 123, which is the low from April last year, could be offering a support. If we do get sort of a hawkish sounding Bank of England, which to be honest, I'm not necessarily expecting, but it is still a possibility. 125 is the level that we need to get above. If we get above 125, that brings us to 126 as a focus. And then obviously we can't forget to look at the FTSE 100, which seems to have woken up after 9 months of slumber. So we saw it traded really within quite a familiar pattern across pretty much all of the second half of 2024. But we've seen this recent breakout, a cut here. It's you know, picked up from that low in December from 80,000 and rallied sharply higher. RSI is in overbought, so we could expect, like we saw here, a period of consolidation. It's trying to head up to the 87,000. That's the level bulls will be watching for on the upside. On the downside, a break below 85.80 could just negate that near-term uptrend, but it's not gonna, you know, we're not gonna really see a lower until we get below the 84.90 level, which was the all-time high, the previous all-time high. So FTSE is being boosted by strength in international stocks as we've got that weaker pound. Also, you know, optimism surrounding interest rate cuts by the Bank of England, and also the banks are performing well. We've also seen solid recovery in mining stocks, as well as we've seen that sort of the stimulus measures in China come into action. Right, so that's the Bank of England interest rate decision. Then we've got, we can't forget, US non-farm payrolls. Maybe I should have done it first, but I'm just keeping you hanging on till the end here. So US non-farm payrolls. This is the jobs data that we watch closely. It's part of the Federal Reserve's dual mandate to watch jobs and also price pressures and inflation. So this jobs data, let's just remember what happened in December. We had a much stronger than expected jobs creation of 256,000, well above the 160,000 forecast, which is really highlighting the strength in the labour market. Unemployment also ticked lower. So across this week coming, we'll see, you know, plenty of forward leading indicators such as the ADP payrolls and the the employment subcomponents to the services and manufacturing ISM figures, which will also provide clues to what to expect from the non-farm payroll. But I mean, the data comes after the Fed left interest rates unchanged, and they said they were in no rush to cut rates. So, you know, if we do see a resilient labour market, that's just going to weigh on those rate cut expectations and could actually be negative as far as stocks are concerned. US inflation is above that 2% target level, so a solid, resilient labour market is not going to cause the Fed any need to rush into rate cuts. Also next week, we also have earnings from lots of US companies. Alphabet and Amazon will be the main ones that we'll be watching out for as the Magnificent Seven continue to provide mixed responses to the market to their results. We saw Microsoft fall after theirs, but Tesla and Meta have risen. As I said, we've got Alphabet on the 4th of February, Amazon are on the 6th. Also, other numbers from Disney, PepsiCo, AMD. So lots of earnings to be watching out for as well. This is the S&P 500. This is that sell-off that we saw on Monday, but look, that long lower wick suggests there was really little selling demand at those lower levels. Price then rebounded back above the 50 SMA, which is a really encouraging sign. Levels to be looking out for: 61.30 on the upside. That's going to create a fresh all-time high for the S&P 500 as we head into the new week. Also, let's just have a quick look at the NASDAQ whilst we're here. Again, we had similar pattern, that long lower wick back above the 50 SMA, not at all-time highs, is at the moment in danger of forming sort of lower lows if we see any reversal here, but I'm confident that the 50 SMA is supporting prices right now. Be looking for a rise above the 21,900 to reach 22,100 and fresh all-time highs on the upside. Support there at 50 SMA around 21,300. Lower low comes if we test that, but look, every time we've been near that, it's had quite a long lower wick. So but if we do get a breakthrough there, which is also the 100 SMA, that's going to create a lower low. So that's everything. I hope you've enjoyed everything that we've covered today, and I look forward to catching up with you next week. Thank you.